13 months ago, my credit score was 580, and a landlord rejected my rental application in front of my then-girlfriend. Last week, the same score read 780, and a bank pre-approved me for a mortgage at the lowest tier rate they offer. The 200-point swing was not magic. It was not a credit repair company, and it did not require paying off some massive debt overnight. It was 5 specific moves I ran in a strict order. Stick around, because step 3 is the one that goes against almost every piece of advice on YouTube, and it is the move that actually broke the score open for me. Quick reminder, this is not financial advice. It is for educational purposes only.
Always do your own research and consider speaking to a licensed advisor before any major credit or money decision. Step number 1 was pulling all 3 reports. Not the FICO score number on your banking app, the actual reports from Equifax, Experian, and TransUnion. You get 1 free pull per bureau per year at annualcreditreport.com. And during the past few years, they've been offering weekly free pulls. I printed all 3. I read every single line. I found 4 collection accounts I had completely forgotten about, 2 of which were actually paid off but still being reported as outstanding, and 1 was not even mine. It was a medical bill from a hospital in a state I have never lived in. I disputed every line that was either inaccurate or already paid using the Bureau's online dispute portal. 2 of the 4 came off in 30 days. The medical bill that was not mine came off in 19 days because the original creditor never responded to verify it within the federal 60-day window, which legally requires the Bureau to remove it. That alone moved my score from 580 to 612 in the first reporting cycle. 32 points for 90 minutes of work. Step number 2 was the utilization fix. This is the math nobody runs through clearly. Your credit utilization is your total credit card balance divided by your total credit limit, expressed as a percentage. The bureaus reward you when utilization is under 30%. They reward you more when it is under 10%. They reward you the most when it is between 1 and 3%. Yes, not 0, but a small reported balance. 0 across all cards actually scores worse than 2%. Because it signals you are not using credit at all. At the time, I had a total credit limit of $6,500 across 3 cards, and I was carrying balances of $4,100. That is 63% utilization, score crushing. I did 2 things. First, I paid down the highest utilization card to under 10% using a tax refund and 2 months of aggressive budgeting. That moved my overall utilization to 31%. Second, I requested a credit limit increase on my oldest card. The issuer raised my limit from $2,500 to $5,000 with no hard pull. That single move dropped my utilization to 22% without me paying down another dollar. By the end of month 4, my score had moved from 612 to 668. 48 more points just from utilization mechanics. Step number 3 is the counterintuitive one, and this is where every YouTube finance channel tells you the opposite of what actually works. I opened a new credit card, specifically, on purpose, with a known 15-point hard pull cost, and it gained me over 40 points within 90 days. Here's why it works. A new card increases your total available credit, which slashes your utilization percentage instantly. If you have $6,000 in total credit and you add a card with a $4,000 limit, your total goes to $10,000. The same balance now sits at a lower utilization ratio overnight. The 15-point hit from a hard inquiry is temporary. It ages off your score impact in 6 months and falls off your report entirely in 2 years. The utilization boost is permanent as long as you keep the card open. On net, a new card opened correctly is a positive score move within 90 days, not a negative one. What's the highest single jump you ever got on your credit score in 1 month? Drop the number in the comments. I want to see what the real range looks like for people watching. Step number 4 was setting up autopay for the statement balance in full on every single card. Not the minimum, the full statement balance. Payment history is 35% of your FICO score, the single largest factor. One 30-day late payment can cost you 80 to 100 points. Autopay for the statement balance in full means you cannot miss a payment, and you cannot carry a balance that triggers interest charges. I set this up on day one of month one, and over 13 months, I had 0 late payments reported across all 4 cards. That perfect payment record is what compounded every other move. Step number 5 was the long game move, letting age and mix do their work without touching anything. After month 6, I stopped opening new cards, stopped requesting limit increases, and stopped doing anything active. 2 factors continue to work in the background regardless of what you do. The average age of your accounts grows by exactly 1 month every month you do not open new credit. And the credit mix factor, which rewards having different types of credit like cards, an installment loan, and an auto loan, slowly recalculates as accounts age. From month 7 through month 13, I gained another 54 points on pure aging and mix recalculation alone. Adding it all up, 32 points from disputes, 48 points from utilization, 41 points from a new card boost, 25 points from the perfect autopay record, and 54 points for natural aging. That sums to 200 points. Same person, same income, same job, different system. The downside to know about: if you open new cards while you have an active mortgage or auto loan application in process, the hard inquiry can derail the rate you are approved for. Run this playbook when you're not in the middle of a major loan application. Give yourself at least 6 months of buffer before any big credit event, and never apply for more than 1 card in any given 3-month window. Watch this next video for the exact dispute letter template I used to remove 3 negative items from my report in under 30 days, plus the specific federal law I cited that forced 2 of the bureaus to remove items without verification.